All right, everybody, welcome back. Today, we're taking a deep dive into the fascinating world of Bollinger Bands. Now, if you're even remotely interested in technical analysis or trying to, get a little bit of an edge in the market, you've probably heard of these things.
Oh, yeah, for sure. They're kind of a staple in the trader's toolbox, right?
Absolutely. But they can seem a bit mysterious at first, like, what are these bands all about? How do they actually help us make better trading decisions?
Right. There's definitely more to them than meets the eye.
That's exactly why we're diving deep today. We're going to break down exactly how they work, how to interpret them, and most importantly, how to actually use them in your trading strategy. Sound good?
Sounds great. Let's do it.
Okay, so let's start with the basics. What exactly are Bollinger Bands? I mean, I know there are these lines that kind of wrap around the price chart, but what do they actually represent?
Yeah, so at their core, Bollinger Bands are all about visualizing volatility. They give you a visual representation of how much a stock's price is fluctuating over time.
Okay, and how do they actually calculate that? It can't just be randomly drawing lines around the price, right?
You're exactly right. There's a very specific formula behind it. So imagine you've got a stock's price chart, right? And you calculate the 20-day moving average, which is basically the average price over the last 20 days.
Okay, got it. That's like smoothing out the price action a bit, giving you a sense of the general trend.
Exactly. Now, the Bollinger Bands are calculated by adding and subtracting two standard deviations from that 20-day moving average.
Wait, standard deviations. Now that rings a bell from way back in stats class, but can you refresh my memory on what that means in this context?
Sure. Imagine you're measuring the height of everyone in a room, right? The average height gives you a general idea, but standard deviation tells you how much the individual heights are spread out from that average. A large standard deviation means you've got some really tall folks and some really short folks, while a small standard deviation means everyone's height is pretty close to the average.
Ah, I see. So when the stock price is bouncing all over the place, the standard deviation is bigger, and that makes the Bollinger Bands wider, right?
Exactly. And that tells us that volatility is picking up. On the flip side, when the bands get narrow, it means the price is moving in a tighter range and things are relatively calm.
So it's like the wider the bands, the wilder the party.
Pretty much. You could think of it that way.
Okay, I'm starting to get the picture here.
Yeah.
Now, how do traders actually use this information to make, actual trading decisions?
There are a couple of ways. One of the most popular uses is to identify potential overbought or oversold conditions.
Okay, how do we do that with the bands?
Well, when the price of a stock repeatedly touches or even breaks above the upper Bollinger Band, it's often seen as a sign that it might be getting overbought, like it's gotten a bit ahead of itself.
Kind of like that party analogy again. The music's been thumping all night, everyone's hyped up, but at some point, the energy has to fade.
Right. Now, this doesn't necessarily mean you should automatically short the stock, but it's a signal to maybe proceed with a bit more caution.
Got it. So it's a yellow flag, not necessarily a red light.
Exactly. And on the flip side, when the price keeps dipping down to the lower band or even below, it could suggest that the stock is oversold and potentially due for a bounce.
Interesting. So basically, the bands give us a way to gauge those extremes of sentiment, those points where the market might be getting a little too greedy or a little too fearful.
Right. It's all about reading the emotions baked into the price action. Now, it's super important to remember that Bollinger Bands aren't, some magic crystal ball. They don't guarantee that the price will reverse just because it touches a band.
Right. They're more like a suggestion, a hint, a nudge in a certain direction.
Precisely. They give you valuable information about volatility and potential turning points, but they work best when you combine them with other tools and indicators.
Yeah, it's like you said earlier, it's like detective work. You wouldn't want to convict someone based on a single fingerprint. You need more evidence, right?
Exactly. You want to look for confirmation from other indicators to strengthen your conviction.
So what are some of the other indicators that work well with Bollinger Bands?
Well, John Bollinger himself was a big advocate for using them with MACD and RSI, which are momentum indicators.
And why those two specifically?
Well, MACD helps you identify changes in the direction of the trend, while RSI measures the strength of the price move and can warn you about potential overbought or oversold conditions.
So together, they can help you confirm whether those touches on the Bollinger Bands are actually meaningful or not.
Right. Exactly. For example, you might see a stock that's hitting the upper Bollinger Band, suggesting it could be overbought. But if RSI is still showing strong upward momentum, it might mean the rally still has some legs.
Got it. So we're looking for those situations where the signals align, where the Bollinger Bands are telling us one thing, and then other indicators are backing that up.
That's the idea. You want to build a strong case before you pull the trigger on any trade.
Makes sense. Now, before we wrap things up, I want to get your thoughts on something. We've been talking about Bollinger Bands in the context of stocks, but could they be applied to other markets, like, say, real estate or crypto?
Hmm. That's an interesting question. And I think the answer is yes, absolutely. I mean, anything that has price fluctuations can potentially be analyzed using Bollinger Bands.
So we could, like, plot the average home price in a certain city and then see how the actual prices fluctuate around that average.
Precisely. And those bands could give you a visual representation of how volatile the real estate market is in that area.
Or we could see, like, how crazy the swings in Bitcoin or Ethereum are compared to their average price.
Exactly. It's all about understanding the dynamics of volatility and how it plays out in different markets.
That's pretty cool. It makes you wonder what kind of insights you could uncover, right? Well, folks, that's our deep dive on Bollinger Bands. Hopefully you gained a better understanding of how they work, how to interpret them, and how to use them to your advantage.
Remember, though, it's just one tool in the trader's arsenal. The key is to combine it with other forms of analysis, manage your risk, and most importantly, keep learning and refining your strategy.
Well said. Thanks for joining us on this deep dive, everyone. We'll see you next time.
See you then.